Welcome back to Investing Talk podcast. Today, we are digging into a name everyone knows, Gap. It's been a bit quiet for a while, but things seem to be changing. So the big question we're asking is plain and simple. Is Gap a good buy right now? We've gathered the latest analysis, analyst reports, the catalyst schedule, basically everything we need to try and give you a clear answer.
That's exactly the plan. We're pulling together all this fresh information, the fundamentals, the technical charts, what the big institutions are doing to give you the whole picture. The goal is you get the key takeaways without drowning in, endless reports. We're doing the legwork.
Precisely. And hey, before we jump into this turnaround story, if you're getting value out of this, learning something useful, please hit subscribe, like the video, leave a comment. It really helps us out. Oh, and if there's a company you want us to analyze, just drop the name or ticker in the comments below. Seriously, look at those. Okay, let's get into the financials, because the main story here isn't quite what you might expect first glance. When you look at Gap, it's not about huge sales increases. Revenue is only up, what, 1.32%? For fiscal 24, about $15 billion.
Right. Pretty modest top-line growth.
But the real news, the thing driving confidence, seems to be how well they're managing operations. Discipline leading to better margins. That's the key fundamental point, isn't it?
It absolutely is. And the numbers really shout that loud and clear. Revenue growth was small, okay? But net income, that exploded. For the last 12 months, net income hit $889 million. That's up a massive 68.13% compared to the year before.
Wow, 68%.
Yeah, think about that. They barely sold more stuff, but made almost 70% more profit from it. It signals really tight control over costs, managing inventory smartly, getting more efficient with every sale. They're not just chasing volume anymore.
That's textbook turnaround execution. And then you look at the valuation. That's where it gets interesting for potential buyers, right? The market cap is around $8 billion, but the price to earnings ratio, the PE, is way down at 9.31. That feels low.
It is low. And let's, pause on that 9.31 PE for a second. That ratio tells you how much the market's paying for each dollar of Gap's earnings. And yeah, compared to the wider retail sector, that's often much higher. So a PE of just over 9 suggests the market maybe hasn't fully caught up to that huge 68% earnings jump we just talked about.
So the stock's possibly still being valued like the old struggling Gap, not this leaner, more profitable version we're seeing now. That's a potential value opportunity.
Exactly. But value's only good if the business itself is sound, fundamentally.
Right. The foundation, solid.
It seems to be. What's good here is the balance sheet looks pretty robust. They've kept debt under control, so no major red flags hanging over them. And crucially, they're generating strong free cash flow year after year. That cash flow makes their shareholder commitments very manageable.
Speaking of shareholders, let's touch on the dividend. They're paying out 3.06% yield currently.
Correct. A yield of 3.06%, which is quite decent in retail these days.
And is it safe? Can they keep paying it?
Looks like it. The payout ratio, that's the slice of profits going to dividends, is only 28.21%. That's very conservative. It means they can easily afford that current quarterly dividend, the 0.165 cents per share when the ex-dividend date is October 8th, 2025, and still have plenty left over for investing in the business or handling, economic bumps. It shows confidence from management.
Okay, so the overall financials look surprisingly strong. But Gap isn't just one thing, is it? It's a collection of brands. Old Navy, Gap itself, Banana Republic, Athleta. If the total revenue growth was slow, which parts of that portfolio are actually powering this margin improvement? Where's the strength?
Well, the main engines really seem to be Athleta and, very importantly, Old Navy. Athleta gives them a strong foothold in that booming kind of premium athletic wear market, competing with the big names there. And Old Navy, that anchors them solidly in the value part of the market, which tends to hold up better when shoppers get cautious about spending.
So a bit of premium growth potential with Athleta and value resilience with Old Navy. That sounds like a smart mix.
It is, and analysts are noticing. Commentary, particularly from firms like BTI, highlights that the cost discipline we saw driving profits, plus this renewed focus on Old Navy and Athleta. That's key to keeping those better margins going. They seem to be shifting away from heavy discounting, focusing more on product and smoother inventory flow.
And it seems Wall Street is buying into this story. What are the analysts saying overall? The ratings, the price targets?
The consensus view is definitely bullish, strongly bullish, actually. We're seeing something like 13 to 15 analysts with buy ratings right now. The average price target is hovering around $25.23. That implies, what, about 16.8% potential upside from where the stock's been trading recently?
16, 17% upside on average. And are there higher targets out there?
Yeah, you see some real conviction, like BT Egg sticking with a $30 target. That suggests they believe the margin improvements could come even faster or be even stronger.
$30 is quite optimistic.
Mhm.
But, there's always another side. Any analysts urging a bit more caution? Any mixed signals we should know about?
Yeah, you do have to acknowledge some nuances. While the overall move is positive, there are slight differences on the short-term view. Goldman Sachs, for instance, they recently trimmed their target just a little, down to $26. It didn't really change their long-term positive view, but maybe suggested the stock had run up a bit fast in the very near term. That kind of adjustment brought the overall average consensus down slightly, closer to $25.75. So maybe some disagreement on the immediate ceiling, but pretty much everyone agrees the long-term direction looks positive.
That's a useful bit of balance. Okay, financials look better, analysts are mostly positive, but stocks often move on momentum too, right? Not just the numbers. So let's shift gears to the technical side, the charts. The stock's been trading, what, between roughly $20.35 and $21.62 lately. That's way up from its 52-week low, near $17.
hmm
What's the price action telling us? Where might it be heading next based on the charts?
Well, the technical picture definitely confirms that bullish momentum we've been talking about. The stock is trading above both its 50-day and its 200-day moving averages. For listeners maybe less familiar with charts, that's a classic sign of an established uptrend.
Short-term strength backed by the longer trend.
Exactly. Technical analysts seem to be looking at a trading range between, say, $20 and $25 over the next 3 months or so, which points towards it continuing to climb toward those analyst targets we mentioned.
Okay, technicals look strong. Which brings us to something that really jumped out from the data, the institutional interest. The volume figures are kind of wild. Recent institutional options activity surged by 609%. 600%. What on earth is going on there? That's not typical for Gap, is it?
No, it's absolutely not typical. You're right to flag that. A 609% jump in institutional options volume is, well, it's a huge signal. It points to large institutions actively accumulating positions and doing it aggressively through options. They're making leveraged bets on continued upside.
Big money is betting big.
Big time. They're not just buying shares quietly, they're using options, likely because they think the stock is still significantly mispriced, especially heading into that key earnings report.
That sounds like massive conviction. But when you see that kind of leveraged betting, doesn't that usually come with higher risk?
It absolutely does. That huge institutional enthusiasm needs a bit of a warning label attached. And that label is GAP's beta. It's 2.08.
Okay, beta 2.08. Remind us what that means.
Sure. Beta measures how much a stock tends to move compared to the overall market, like the S&P 500. A beta of 1 means it moves in line with the market. A beta over 2, like GAP's 2.08, means it's highly sensitive. It tends to move more than twice as much as the market, both up and down.
So if the market has a bad day, drops 1%, Gap could easily drop 2% or even more.
Potentially, yes. That's the amplification effect. It magnifies the potential gains the institutions are chasing, but it also magnifies the downside risk for anyone holding the stock.
So definitely not a set it and forget it stock. Needs monitoring.
Precisely. That high beta means you need to watch the broader market conditions closely if you're invested here.
Now, this institutional confidence is one thing, but we also saw some insider activity going the other way. A director, William Sidney Fisher, sold a pretty big chunk of shares, over 243,000 shares back in early September at around $23.82. To an outsider, that looks like a big vote of no confidence. How do we reconcile a huge insider sale with that massive 600% surge in bullish options betting?
That's a really important point to address. You see an insider sale like that, and it definitely catches your eye. But we have to consider the context. Insiders sell for lots of reasons that have nothing to do with the company's future prospects. Maybe they need cash, maybe it's tax planning, or just rebalancing their portfolio after the stock has had a strong run, which Gap certainly has.
So it's not automatically an alarm bell.
Not automatically.
Wow.
If it were a real sign that insiders thought things were about to go south, you'd probably expect to see more selling from multiple executives, right? And you probably wouldn't see institutions piling in with leveraged bets at the same time.
Right, we're seeing the opposite on the institutional side.
Exactly. So while you always note an insider sale, the most likely explanation here, given the overwhelming institutional bullishness, is probably personal portfolio management or rebalancing, rather than a warning sign about the company itself.
Yeah.
But still, something to keep noted.
Okay, that makes sense. So thinking shorter term now, say the next few months, what are the specific events coming up that could really move the stock price? What are the catalysts?
The biggest one, without a doubt, is the Q3 earnings report for fiscal 2025. That's scheduled for November 22nd, 2025. Everyone will be watching to see if that margin expansion story continues. If they beat expectations there, especially on margins, you could easily see the stock push towards the higher end of those analyst targets, maybe $25, even closer to $30.
November 22nd. Got it. Anything else significant before year end?
Yep, two other dates to watch. First, the actual payment date for that third quarter dividend is October 29th, 2025. Less of a market mover, but confirms cash flow. And then, really important for retail, is the holiday sales update. That usually comes out around December 20th. It gives an early read on how the crucial fourth quarter, the holiday season, is shaping up.
Okay, those are the scheduled events. What about, the rumor mill? Any speculative buzz or potential surprises floating around that could boost the stock if they happened?
There's always some chatter. One persistent theme is potential strategic partnerships. Maybe for Athleta, given its growth, or even for Banana Republic now that it's being repositioned. A big partnership announcement could definitely unlock value. There's also ongoing talk about them maybe speeding up store closures, getting rid of underperforming locations faster to boost overall profits. And finally, if that free cash flow stays strong, like we discussed, there's always speculation about them increasing their share buyback program. Buying back more shares automatically lifts earnings per share.
Right. All potentially positive catalysts, but still just speculation at this point.
Exactly. Unconfirmed.
So let's wrap this up by focusing on risk. If someone listening decides Gap looks interesting, what are the main headwinds they need to be prepared for? How do you mitigate the risk here?
Well, the biggest one is simply the economy. Gap is still a retailer, right? So it's very exposed to swings in the retail sector, changes in consumer spending. If inflation picks up again or people just get worried and cut back, Gap will feel it.
Macro risk. Got it. And the second risk?
The second risk takes us right back to that beta number.
The 2.08.
Yep. That high beta means volatility. You as an investor just have to be ready for potentially bigger swings than the overall market. The stock has shown it can bounce back, but when the market drops, Gap is likely to drop harder. It just requires more attention than, say, a stable low-beta utility stock.
Okay. So putting it all together now, the improving fundamentals, that strong bullish consensus from analysts, the powerful technical momentum, but keeping that high beta risk factor firmly in mind. What's the bottom line?
Well, synthesizing all those pieces, the profit growth, the valuation, the institutional bets, the overall investment case looks pretty compelling. We'd give it a bullish rating, maybe an 8.5 out of 10. It's backed by real financial improvement and those strong analyst targets.
And is this more of a short-term trade opportunity, maybe playing the run-up to earnings? Or is there a longer-term investment case too?
It actually looks interesting for both, potentially. There's definitely a short-term angle, trying to capture momentum leading into that November 22nd earnings report. A good report could definitely pop the stock higher. But there's also a solid case for a longer-term hold, based on management's focus on improving the business across all channels and the strength they're showing in Old Navy and Athleta specifically.
That makes a lot of sense. Okay, so a final thought for everyone listening to chew on. We've seen the operational improvements are real, the options volume is suggesting massive institutional optimism, and the stock has already climbed significantly off its lows. So the question is, how much of Gap's current price is reflecting the solid fundamentals we've discussed? And how much might already be pricing in a perfect slam dunk earnings report come November? Is the good news already baked in? Something to consider.